wealthbranch.com.
Preferred dividend stocks. Preferred stock gets its name because it has preference over common stock. Preferred shareholders receive dividends before common stock shareholders. Preferred shares fill the gap between a common share and a bond. In this sense, preferred stock has a degree of ownership but has fixed payments like a bond. Preferred shares generally have no maturity date and will perpetually pay a dividend unless the company repurchases the shares or goes bankrupt. Option to redeem shares, callable. Callable shares can be repurchased by the company at any time for any reason. Preferred stocks are typically redeemable 5 years after being issued. The par value is the price at which the company can redeem the stock, usually $25 plus accrued dividends. If the interest rates are lower than the dividend interest rate, the company is more likely to redeem the stock and refinance the debt by issuing securities with a lower coupon. Bankruptcy and liquidation. Legendary fund manager Li Lu once said, "The biggest investment risk is not the volatility of prices, but whether you will suffer a permanent loss of capital." It's essential to read the prospectus and to know what will happen if the company stops paying dividends or is liquidated. The prospectus will tell you if the dividend is cumulative or non-cumulative. Cumulative dividends. If the preferred shares are cumulative, the company must make up all missed dividend payments at a later time. Unpaid dividends are cumulative and must be paid before any dividend is paid to common shareholders. In the event of company liquidation, the preferred shareholders may redeem their shares and cumulative missed dividend payments. Non-cumulative dividends. With non-cumulative preferred dividends, if the company misses a payment, then it is not obligated to make up the dividend payments later. The company may elect to not pay both the preferred and common stock dividends. However, preferred stock owners still get paid before common shareholders. Advantages of preferred dividends. Priority payment. Preferred shareholders receive dividend priority over common shareholders. For example, in 2019, due to an unexpected lawsuit, shopping mall REIT CBL and Associates suspended dividend for common shareholders, but they continued to pay the dividend to preferred shareholders. Fixed dividend payment. The most significant advantage of owning a preferred dividend stock is the predictable fixed dividend payments, providing more stability for shareholders, as opposed to common shareholders who do not know how much they will receive or if they will be paid at all. Higher yield. Preferred shares often have a higher yield than common stock. Transparency. The preferred stock rates and terms are displayed on the balance sheets of the company and in the prospectus. Disadvantages of preferred dividends. No dividend increases. Typically, a quality company will grow and increase the dividends it pays to common stock shareholders. However, preferred dividend shareholders will not receive dividend increases. No growth. Typically, the price of a preferred dividend stock will be flat or go down over time. No voting rights. Depending on the company, preferred shareholders usually do not have voting rights. No special dividend payments. Common stock shareholders, depending on the company, have the opportunity to receive special dividends. Inflation. Fixed rates can also be disadvantageous when inflation is high because the dividend rates are not adjusted for inflation. Over time, when there is inflation, the fixed dividend will lose purchasing power. Taxes. They can also be taxed at much higher rates than other dividends, sometimes as much as 35%. With that, different kinds of preferred dividends exist with different tax consequences. Default. Companies are obligated to make up past due preferred dividend payments. However, that is not always possible. If the company goes bankrupt and still has past dividend payments due, it may not have the money to make those missed payments. Preferred dividend payout ratio. Like the dividend payout ratio of common shares, we can calculate the dividend payout ratio of preferred shares. The formula is preferred dividend payout ratio equals net income divided by required preferred dividend payout.